It operates like a tightly engineered system. The architect of this specific system is billionaire investor Charlie Munger. Munger approaches capital allocation with strict mathematical logic, treating the acquisition of wealth as a rigid, reproducible formula. He breaks the process down into a sequence of 5 distinct steps. The mechanics of this sequence remain identical whether you start with a net worth of 0 or scaling an existing portfolio into the billions. We're going to reverse engineer Munger's exact protocol, step by step. We will map out precisely how to convert raw human capital, your time, labor, and skills, into compounding financial equity. Reaching multimillionaire status does not require guessing the future of the market. It relies on building this exact architectural machine, configuring the inputs, and letting the engine run. This diagram illustrates a highly inefficient approach to navigating the job market or launching a business. A broad, scattered effort yields a massive failure rate. Energy is dispersed across empty, unresponsive areas of the economy. Munger summarizes the correction to this error with a simple rule: fish where the fish are. The baseline expertise of the fisherman matters significantly less than the existence and density of the fish in that specific location. Instead of relying on volume, the optimal strategy requires intense, targeted positioning. It means conducting deep research to identify the exact companies actively seeking your highly specific set of qualifications and deploying all your resources directly into that concentrated zone. The mechanics of this targeting apply identically across all income streams. If you are launching a product, offering B2B services, or starting a freelance agency, success requires finding locations where your target demographic aggregates and establishing your presence there. Step 1 in Munger's system prioritizes strategic positioning over raw exertion. It requires engineering your geographic and industrial location specifically to maximize the probability of capturing capital. This graph tracks the trajectory of early wealth building, highlighting the steep red friction zone between 0 and the first $100,000 in savings. This initial phase is grueling because the individual possesses 0 financial leverage. Coming out of the education system, your only tradable assets are your skills and your physical time. You are relying purely on human capital to generate momentum. Consider a recent marketing graduate trying to force their way to a 6-figure salary. When high-paying roles remain out of reach, the strategic pivot is to accept a lower-paying adjacent position. The immediate goal is no longer the highest possible wage, but the rapid accumulation of specialized experience. It requires years of strict dedication in those lower-tier roles to build a resume strong enough to finally secure that $100,000 marketing position. The early friction is immense. To cross this threshold, Munger advocates for immediate, systematic execution. Consistently routing small amounts of capital into investments mathematically outperforms waiting to deploy a large lump sum. The action of saving must be constant. Breaking this exact 6-figure barrier is the crucial inflection point in the timeline. Once you clear $100,000, you have established a self-sustaining financial foundation, and wealth generation transitions from grueling manual labor into automated momentum. This Sankey diagram illustrates the mechanics of personal cash flow. The standard advice to live below your means is often treated as passive frugality. In a high-functioning system, it is actively engineered. The goal is to enforce a permanent, structural spread between the income stream and the expense stream, capturing the excess in a surplus reservoir. The fastest way to widen this spread is by applying corporate leverage. This means demonstrating objective value to your current employer to negotiate a higher base salary, or aggressively leveraging your resume to secure a premium wage at a competing firm. The second lever is acquiring high-demand technical skills, such as UI/UX design, web development, or direct response copywriting, and operating a specialized freelance side hustle. This forces a secondary stream of capital into the main flow. The third lever requires utilizing physical assets. Renting out a spare room or operating an Airbnb model transforms dead, unused space into an active cash-flowing asset, expanding the total surplus. Raw top-line income has 0 impact on your net worth if your expense output scales to match it. True financial velocity is determined exclusively by the width of the spread you maintain between those two streams. This split-screen chart visualizes the mathematical limits of a standard W-2 income compared to the compounding potential of asset ownership. An hourly or salaried wage will always cap out, constrained by the physical hours in a day. Equity faces no such limit. Munger's own financial trajectory operates as the ultimate proof of this concept. Over a span of nearly half a century, his personal net worth scaled to an estimated $2 billion. Yet, his actual salary as the vice president of Berkshire Hathaway remains shockingly low. He earns less in standard base pay then a multitude of junior investment bankers and software engineers just entering the workforce. We see this exact wealth model replicated continuously by workers in the IT sector. Employees trade their time in demanding, chaotic startup environments, often accepting a lower initial salary in exchange for aggressive company stock grants. The mechanics here are straightforward. Acquiring shares of stock transitions you from an employee into a partial owner. You become directly entitled to a compounding share of that firm's physical assets and its future earnings. As the structural foundation of the tech sector rapidly expanded, an entire generation of workers achieved multi-millionaire status. Their wealth was generated strictly through the appreciation of their equity ownership, not their biweekly paychecks. You cannot save your way to extreme wealth using only a salary. You must eventually convert your surplus capital into compounding equity. This risk-return matrix plots the standard retail investing approach. Conventional financial advice mandates maximum diversification, suggesting that spreading your capital across dozens of different assets is the safest strategy. Munger completely rejects this model. He argues that spreading capital too thin dilutes total returns, increases transaction friction, and introduces unmanageable complexity. Instead of holding small percentages of 50 mediocre companies, Munger executes a strategy of severe concentration. He isolates a fraction of the market and aggressively capitalizes the winners. By his own admission, the vast majority of Munger's multi-billion-dollar fortune rests upon just three primary pillars: a massive block of Berkshire Hathaway, a massive block of Costco, and capital in Li Lu's fund. This approach has strict prerequisites. It requires the investor to completely ignore standard market noise, identify a select group of high-quality opportunities, and purchase them with a mathematically rigorous margin of safety. Extreme wealth is not protected by owning a tiny sliver of the entire economy. It is protected by possessing deep, unshakable conviction in a vital few assets and holding them over decades. When you align these individual principles, the architecture operates in perfect synchronization. The system converts raw human effort into a self-sustaining cycle of capital growth. The sequence is fixed. You utilize targeted positioning to identify high-yield opportunities. You enforce a strict capital spread to generate a continuous surplus. You push that surplus past the heavy friction of the $100,000 threshold. You convert the cash into compounding equity, and you aggressively concentrate that equity into high-conviction assets. None of these steps require a genius-level intellect or insider market knowledge. They require relentless discipline, emotional stability, and an uncompromising adherence to the formula. Earning your first $100,000 is the ultimate test of your human capital. Everything that follows is the ultimate test of your capital allocation.